now you've got your accounting system and your permits and your contracts or your purchase orders, all your documents. You're going to want to list all your financial resources. Before you ask anybody else for money, the first thing they're going to ask you is, what do you have to contribute? So preparing a personal financial statement is always a good thing, listing your assets, your liabilities. And then that also helps you, which is the next step of preparing a personal budget. If you're going to start this business, how much money do you need to make? And Amanda and I do these workshops, and the biggest aha that these people have that have started their business is they think they make money and they haven't paid themselves. So you don't make money if you haven't paid yourself. You've sort of tapped out your credit cards, your friends and family, you still need money. Crowdfunding is not a bad way to go. There's two different kinds of crowdfunding now. Last time I did this, there was actually only one, but this first kind is the one you've probably heard about. It's rewards-based crowdfunding, which is you go online, you want to raise money, you have to give them something in return. You can't just take people's money. Even if it's a t-shirt, you have to give some sort of reward for the money you're raising. It does cost money unless you're a not-for-profit. There are some, and I'll go through the top 7, but they charge anywhere from 4 to 5% administration fee of the money raised. And then some are all or nothing, like Kickstarter is all or nothing. If you tell Kickstarter, I want to raise $50,000 and you only raise 40, you don't get any of it. If you go to an Indiegogo and theirs is not an all or nothing, but you don't make your goal, then that administration fee is 9%. So you have to really think about whether you're going to make that. And then every one of them, even the nonprofits, have a processing fee because most people pay by credit card online for their pledges, and that processing fee is passed on to you. So that's anywhere from 2 to 3%. And then most of these crowdfunding sites also charge 20 to 30 cents per pledge. So you have to make sure you factor that into the money you need to raise. That when all is said and done, you're only going to get 92 to 93% of the money you raise. The thing I stress about crowdfunding is that it's really important that you have a very strong social media presence before you go out to a crowdfunding site and pitch your idea. Crowdfunding statistics, they did this study at the University of North Carolina, and it basically proved that the number of pledges you have is a better indicator of your success than the amount of money you raise. And so the stronger your social media presence, how many people you reach, and how many people actually pledge for your business or your product or your idea is actually very dependent on that social media outreach. It's called Jumpstart Our Business Startups. And within that act, there was the ability to do crowdfunding that was equity-based, not reward-based, meaning people actually can own your business. They come in and they are equity investors just like your friends and family would be, only they're probably strangers. And now with the crowdfunding, you don't. You just have to make a certain amount of money. You don't have to be a qualified accredited investor. So you are limited. Like if I'm the investor, I'm limited to how much money I make or how much asset I have, and your primary resident isn't included. So a lot of these equity crowdfunding sites are actually being funded by venture capital firms and private equity firms. So it's not for the faint of heart, and the fees of starting a crowdfunding site are very substantial because you have to file all of this regulatory requirement. You also have to file financial statements. Depending on the size, you have to generally get at least a reviewed statement, and those cost a lot of money. But I picked a couple that are pretty active now. When I was here 2 years ago, there were none. But the big ones I saw were EquityNet, WeFunder, and Local Stakes. So if you have like probably an app, who's the guy doing the app? Okay, that's a perfect like equity kind of crowdfunding because you can get technology. The big ones were technology and food. Believe it or not, food and restaurants and technology were the biggest raisers of equity crowdfunding. Most small businesses have to start with something like what I call alternative lenders, which are specialty lenders. And specialty lenders, alternative lenders, are anybody outside of a traditional bank. They call them shadow banking, alternative lenders, whatever, fintech. And you can get almost any kind of loan through them. You can get equipment, leasing, term loans, lines of credit, merchant cash advances, factoring, where they'll buy your receivable for you at a discount to give you funding. The costs are high, but the benefits are they're very fast, they're very flexible, and they're generally based on your personal credit score, not your business. There are some that are based on the business, but these are really good for startups. And it's not a bad way to go, even though it's relatively expensive. It's a good way to go until you're profitable and you don't need that cash every month up front. So SBA loans are designed for small business, thus the name. But the 7A program is what most of you would go to. SBA loans are actually given out by the banks, not the SBA. So there are certain banks, and I actually pulled out the list from the local business journal of the biggest SBA loan lenders based on numbers, not dollar amounts. And it's banks like Live Oak Banking, which I never heard of, Business Finance Group, never heard of, and then it goes into all the big banks. So don't be shy about going into a Wells Fargo or an M&T and trying to get an SBA loan, because they're huge SBA lenders. And all the ones I listed have what they call preferred status. So that means if that bank approves you, you are automatically approved by the SBA. And make sure if you ever go into a bank and you do want to get an SBA loan, that should be the first question. Are you a preferred lender? The SBA is a hard way to go, though, because first of all, you have to prove that you put your own money in. They're going to make you guarantee, they're going to make your spouse guarantee, they're going to make you pledge a house if you have even $1 of equity in it. And it's very hard to get for startups. And I know that seems counterintuitive, but banks, keep in mind the banks are the ones making the loans, not the SBA. Banks don't really like startups. So if you have a lot of personal net worth or you have a lot of equity in a house, then you can probably get an SBA 7A loan. If you have neither of those and you're a true startup with not even a month of revenue, you're not. If you're a franchise or a franchisees, it's a little bit easier because they look at the whole franchise when they do those kinds of loans. So now you might want to go to a bank, a real bank, and get a real bank loan. You're going to need at least 2 to 3 years of history. So for startups, it's nearly impossible. It's similar to an SBA loan, though. If you have very strong personal guarantees, maybe you have some collateral you can pledge, maybe you have a lot of equity in your home, you could go to a bank and get a traditional bank loan for your business. But I'm not going to lie to you, that's really, really hard, almost impossible. There are angel investors out there, and there are pools of venture money, and actually this area is not a bad area for venture money because there's a lot of tech and biotech. But the challenge that a lot of the veterans I've talked to have about venture capital is that they really do gear towards companies that are fast-growing, technology, biotech, because their exit is an IPO or a sale, and most traditional businesses that grow at 5 to 6% are of zero interest to venture capital.